Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis. A warm welcome to my podcast Money Talk for Thursday the 28th of September. Thank you for listening to the show and supporting independent broadcasting and making Money Talk one of the most listened to financial podcasts in Hong Kong. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, profits earned by Chinese industrial firms fell by 11.7% from a year earlier in the first 8 months of 2023, amid weak demand at home and abroad and ongoing margin pressures. The decrease followed a 15.5% slump in the prior period, with profits declining in both state-owned firms and the private sector. China's August industrial profit, though, jumped by 17.2% year-on-year. That's the first increase this year, and it helped narrow the year-to-date year-on-year decline. Reuters reported Wednesday that a major group of offshore creditors of China Evergrande Group is planning to join a court petition to liquidate the cash-strapped developer if it doesn't submit a new debt restructuring plan by next month. The creditor group holds a large portion of Evergrande offshore bonds, and if it decides to join, it would add more weight to the petition filed against the developer by an investor in a Hong Kong court, which is set for a hearing on October the 30th. Bank of Japan policymakers agreed on the need to maintain ultra-loose monetary policy, but were divided on how soon the central bank could end negative interest rates, minutes of its July meeting showed on Wednesday. This was in light of inflation hitting 15 straight months above the Bank of Japan's 2% target. US stocks are on track for their worst month of the year as the Fed's higher for longer interest rates message sends shares and government bonds tumbling on Wall Street. The S&P 500 index has fallen 5.2% in September, dragging it towards its first quarterly loss in 12 months, and the broad-based index is now down almost 300 points. That's 6.4% since July the 26th, when the Fed last raised rates and said they were no longer expecting a recession. On today's programme, my guests are Andrew Freris, the CEO of Ecognosis Advisory, and William Ma, Chief Investment Officer at Grow Investment Group. And with a view from Singapore is Geoff Howie, Market Strategist at the Singapore Exchange. If you want to get in touch, please go to my website, peterlewismoneytalk.substack.com. You can send me any questions or comments there.
Peter Lewis's Money Talk.
On Wall Street, the benchmark S&P 500 index made fractional gains Wednesday after hitting a 3-month low in the previous session. The index edged up under 1 point to close at 4,275. The Dow gave up gains of 113 points from earlier in the session to close 69 points lower. That's about 0.2% at 33,550. The Nasdaq Composite added 0.2% to end the session at 13,093. Energy stocks rose on higher oil prices, with majors ConocoPhillips up 3% and ExxonMobil rising 3.3%. And oil prices surged to a fresh 10-month high on Wednesday, approaching $100 a barrel, as lower than expected US stockpiles added to concerns about the impact of tighter global supplies of crude. Brent crude climbed as high as $97.06 a barrel, that's its highest intraday level since November, before paring the gains slightly to settle 2.8% higher at $96.55 a barrel. Yields on the benchmark 10-year Treasury rose 6 basis points to 4.61% on Wednesday. That's the highest since 2007. And yields on the 30-year note advanced 3 basis points to 4.72%. That's the highest level since 2011. The US dollar rose 0.5% against a basket of 6 peer currencies, hitting a fresh 10-month high, and the dollar scaled multi-month highs against the euro, sterling and the yen. The offshore yuan, though, strengthened 0.2% to 7.32 renminbi per dollar, as the People's Bank of China said it would resolutely prevent currency overshooting risks and keep the yuan basically stable at reasonable balanced levels. Shares in Hong Kong snapped 2 days of losses and climbed off a 10-month low. The Hang Seng Index added 145 points, or 0.8%, to 17,612. For the month of September so far, though, the index is down more than 4%. The tech index rebounded 0.4%, but is down 8.3% month to date. Alibaba jumped 0.7% on news that its logistics arm, Canyo Smart Network, has filed for an IPO in Hong Kong. And the Shanghai Composite, that rose 0.2% to 3,107, and the index there is marginally lower month to date. Does look like, though, the Hang Seng is going to slide a little bit more this morning. Futures markets projecting an open of about 17,560. That's about 50 points lower, or 1/3% lower on the day. You can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
It's almost the end of the week, coming up to a long weekend and the Golden Week holiday, of course, in China. Let's welcome our guests. We have with us Andrew Freris, the CEO of Ecognosis Advisory. Morning, Andrew.
Morning.
And also with us is William Marr, who is Chief Investment Officer at Grow Investment Group. Good morning to you, William.
Good morning, Peter.
Let's start with the markets. We'll start with the US. US stocks on track for their worst month of the year as the Fed's higher for longer interest rates message sends shares and government bonds tumbling on Wall Street, and a looming government shutdown also weighed on sentiment. The S&P 500 is down 5.2% in September, dragging it towards its first quarterly loss in 12 months. And the index has fallen 300 points since July the 26th, that's over 6%, when the Fed raised rates and said they were no longer expecting a recession. Andrew, you've been saying all along that rates are going to be higher for longer, but the markets haven't really believed it, but I think they're starting to believe it now, aren't they?
Well, thank you very much for saying that, Peter. Actually, I take zero pride because me and 9,528 million other observers were saying the same. It was absolutely stunningly obvious. Either you take what the Fed tells you or you don't. Okay, my concern, I keep emphasizing that, is that we are wasting an enormous amount of time trying to, in a sense, guess when the Fed will be happy with the inflation trends, and therefore it will stop increasing interest rates. Can we please forget about it and simply concentrate on areas where we can invest, where interest rates are of no importance? I have a sector which is my favorite, which is interest rate proof, it's defense. And the other part that I started wondering a little bit is whether a number of defense, a number of AI or technology mini sectors or subsectors also can actually shrug off whether the Fed is going to increase again or whether it's going to be stable or not, and simply concentrate on just news. And then there are other areas, again, on the tech side, like Google and Amazon, where they're being absolutely pursued about monopolistic practices. And that is not something easily shruggable. So we've got actual events to worry about as opposed to whether the Fed will or will not increase. Let's forget about it. Interest rates are going to be high for quite a while yet. For quite a while, how much? Let's not waste too much time on that. It won't make any difference.
William, from your perspective, from an investment perspective, I mean, the markets have been fighting the Fed pretty well all year, haven't they? But are you sort of preparing for a long period of high interest rates?
Yes, I have a couple of angles. I think one from the inflation side. I was in the States about 2 weeks ago, and things are super expensive, Peter and Andrew, and the tips and everything. I can feel the inflation, pressure, if you like, and our analysis is it will remain a little bit sticky for a while. When we talk to the Chinese manufacturer, because we are seeing some of them are starting increasing price, and secondly, some of the goods are actually export to Vietnam and other countries and then re-export to the States, which kind of like increase, the cost of inflation. So if oil price is not going down, this type of manufacturing goods are increasing price and service. The staff is not going to reducing salary. I don't see a reason why inflation would go down, and that create one more reason for the Fed to make the interest rate, high for longer. And the second point is from an investment sentiment or investment perspective. When we talk to our Chinese client who have US dollar exposure, some of them are buying, the high fly equity, like Apple and Amazon and Google, but a big part of the portion of their money is actually in bank saving. So given the volatility, if the interest rate is higher for longer, I think the investment appetite for Chinese investor will remain on the kind of like safety deposit, if you like.
Because you can get 2-year yields over 5% now. I mean, that's worth locking in, isn't it? It's a risk-free rate on US Treasuries. It's not too bad.
We've seen two types of, strategy. The one type is quite common. You go to different banks trying to arbitrage, 3 months, 6 months, and 12-month interest rate. Some of the private bank actually is offering like 5.88, for a 6 to 12 months kind of like safety deposit. The other strategy, we've seen some bank and client investing in a notes, with like a 2 years lockup to 5 years lockup. Principal protected, and there is some yield upside with some lock-in function. So I think investors in general are trying to arbitrage or take the safer way, if you like.
Andrew, you mentioned sectors that are hopefully immune from this period of higher for longer interest rates, a period that could go on for a long time if we listen to the Fed. I presume within that you've also got to look very carefully at individual companies, haven't you, and how much debt they have on their balance sheet and when that debt needs to be refinanced, because the days of being able to borrow at close to zero are long gone. They're going to have to refinance at much higher rates.
Absolutely, Peter. As in inverted commas, an investment advisor, God help you. Okay, you know what they say, how to make a small fortune with Andrew Freris says, you start with a big one. Okay. It is much, much more difficult to advise on individual companies because this is incredibly labor intensive, as opposed to doing a blah blah on specific countries. Okay, so I'm afraid I have chosen the more difficult path, and that is to look at sectors, and within sectors look at individual companies to the extent that I can do it through compliance, and particularly on a public platform like yours, number one. Number two is, as opposed to taking the relatively easier way of doing a blah blah, which has zero value added for my clients. I want to tell them that in the United States, interest rates are going to continue to be high for perhaps another year. And what? And where are you going to invest? Well, that's the tricky part. So I prefer to ignore about that. Okay, ignore and stick to that. So yes, you're absolutely right. And even in my favorite sector, which is defense, when I look at something like more than 30 companies in the United States, more than 30 companies in Asia, they are widely different. And also their performance has also been very, very different indeed. In Europe, for example, there are some absolutely high sky performances, okay, driven at the back of the war in Ukraine. And in Asia, there are some, particularly in Japan, that are completely flat. So I would tell my clients, buy anything that has the word D in front of them. All right. Yeah, it is like that. But at least I get rid of the angst, okay, of saying, will they go, won't they go, interest rates up, interest rates down. Okay, the sector looks very good, and within that is relatively easier to find some companies. I hope I'm answering it directly. Okay, yes, it is easy and in inverted commas cheap to go for countries or regions as opposed to go for sectors and specific companies within the sectors.
Okay, I'm going to ask you about specific countries in a moment, but William, let me get your thoughts on this, because Treasury yields now, the 10-year Treasury yield at the highest level in 15 years. I don't think investors have fully realised the significance of this yet.
Yes, and I would like to add a bit on the strategy side. With high interest rate, I've seen, some clients, investor trying to invest in the private debt, asset class. And with high interest rate and the potential lockup, and some of them are actually lending to the so-called technology company at high interest rate. To me, I think is not the best, strategy if you want to lock in, stable return, given potentially if, we are talking about recession, high interest rate, maybe the ability for those companies to pay back debt would be kind of like getting more difficult, while you are not seeing that on a month-on-month NAV basis. But after 2-3 year lockup, you will find out your portfolio might not performing as, mid-teens as some of the funds are suggesting. So I think that is exactly what Andrew mentioned. Besides high interest rate on the treasury yield, we are trying to go into the exact asset class and what people are selling and buying. In order, for safety, we prefer both in China and in global, maybe another type of strategy like convertible bond to kind of like capture this kind of like a downside with a yield, but upside with an equity, call option on the upside.
Right, that's a pretty good asset class in this type of environment, isn't it? Because as you say, you get the yield not as high as on a fixed income bond, but you do get the equity kicker
Exactly. In particular, in China, if I might add a little bit, Peter, is the convertible bond space in China is getting huge in terms of volume. Actually, we are talking about they're close to a quarter of the market turnover of the equity market. And secondly, there is limit up, limit down in convertible bond, 30% up, 30% down. But in equity, it's 10% up and 10% down per day, which makes some of the retail investor trying to trade a convertible bond as a proxy in trading the stocks. And by applying, a Black-Scholes model, actually you can, relatively speaking, strip out the call option pricing, of the convertible bond, which makes, some of the more advanced, fund manager trying to gauge what is the true value of the convertible bond. And matter of, data point, year to date, Hong Kong market was down 10% and A shares is down 4.5, right? Convertible bond strategy is up close to 8%. So I think despite all the macro, in China and global and the high interest rate, if you pick the right sector, like Andrew mentioned, the D, or you pick the right asset class, I would say CB, I think that would be something, you need to implement in your portfolio.
Okay, so convertible bonds.
William, you are a much better man than I am. When I hear I'll take convertibles and strip out the optionality, my eyes glaze, beads of sweat appear on my brow. Leave me out of that, please.
Nevertheless, this is a good time. I used to be a convertible bond trader a long time ago in my early days in Japan. So, it sounds like a good strategy to me, William. What about specific countries, Andrew, in Asia? Where would you look at in this higher for longer environment, and where would you avoid?
Strangely enough, on pure macro basis, okay, and also looking at the commodity prices, I'll clear my throat. Indonesia doesn't look bad at all. I am much more cautious on India, although India, in terms of index performance, has been one of the very few green spots on my Bloomberg screen. Okay, and then the rest of them, I have question marks. In other words, there isn't a huge amount of things that I would go through. I had great hopes of Thailand clearing out the election period, but unfortunately this didn't really make any significant differences. So looking at, in inverted commas, Asia, okay, I will find it very difficult to say Asia as opposed to individual countries. Japan became temporarily a favorite place, but now, given that the question mark continues to raise for how long are they going to keep near zero interest rates, and the answer is it's a beautiful converse, in fact, of the Fed. They're saying we're going to keep them down as long as it takes. And what as long as it takes mean? It might mean another year or so. Okay, despite the fact that for 15 months, inflation in Japan has been increasing, the men for Mars will go absolutely bananas in saying, hang on a minute, these guys, they want more inflation. They just got it for 15 months. What's their problem? The answer is they don't really believe that this is going to stay like that. And hence, uniquely, they still have negative interest rates. I adore that, Peter. When people tell me, central banks have now gone through a period of increasing interest rates, I say, hello, no, they haven't.
I don't know how long that's going to be able to last for, I have to say, because the yen is being held hostage by that, isn't it? And William, that's the other thing we've got to look at the moment, isn't it, from an investment perspective, what this is doing to the dollar. The dollar is just surging against all the major currencies. We're now at a 10-month high for the US dollar index, particularly the yen, but it's given a big boost to the Japanese economy and made the market look investable again. But what are your thoughts on the currency?
Yes, I think the dollar will continue to strengthen. This is our central thesis. So for our clients' global portfolio, a good part is in the US dollar asset. And besides that, we are also having gold and oil, commodity as the portfolio to play part of the global inflation as well as the hedge. We are not in yen or India. I think one point I would like to add on India and Japan is I understand some of the capital is leaving China and look for exposure in Asia. From my 20 years of experience, I think India and Japan are good and important market, but I prefer to go there because we like the country, not because we don't like other country. Otherwise, it would not be a kind of like a longer term view. And secondly, in India, my experience is whether to hedge the rupee or not makes a big difference in your overall investment return. If you're investing in equity market. For non-China in the region, I would say Australia has been a very stable country. Some of the non-commodity related business, they are actually doing very good. Some of the healthcare, they are doing export. I would say those are also defensive, stable sector or countries that we can look besides Japan and India.
Okay. And Andrew, the other thing, of course, we've got to watch oil prices heading towards $100 a barrel, aren't they? Brent crude oil rose above $96 a barrel earlier on today. It has fallen back a little bit. Looks like energy oil supplies are remaining pretty tight, and that's sort of overwhelming the concerns about slowing demand. But of course, this is inflationary, isn't it?
Yeah, well, Peter, I have a very cautionary view as far as oil prices is concerned, because if you look at the uses, oil is not used, not used to make electricity, full stop. Okay, so please, let's leave energy as in electricity prices aside from the impact of that of oil prices. Nearly 20 to 25% of the usage of oil is for transport. And if you look at transport, you look at the United States. So they are much more, all this is much more likely to affect the States rather than affect, let's say, Philippines. Okay. India, however, does have a very sensitive area as far as oil is concerned, because certain aspects of the uses of oil products, for example, and in particular gas for cooking, it's still a very, very important component of the inflationary stroke sector in terms of indexes. So when I look at oil prices, I would say if they're going up, bad news for the States straight away. I'll concentrate on that, as opposed to saying this is going to be bad news for everybody else. Gas prices also is different. Very, very different, because they are not being controlled in the same way that oil prices are. And to the best of my knowledge, I haven't seen yet any attempt to restrict production of natural gas.
William, what's the impact on China of these surging oil prices?
Well, definitely, it's causing inflation everywhere, including in China, right? Although, part of the oil price and raw material is kind of like being subsidized, by the government. And I think important part is it will increase volatility globally. If, oil keep going up, and then as you can see, the US market is going down, and it's not helping the China A-shares market. I think the sort of poor sentiment in A-shares and in Asia, part of it is driven by, the US market volatility as well. So I think keep increasing oil price is not good for equity market. But from a portfolio perspective, I think we do have some exposure, to hedge that type of volatility.
Okay. Well, look, sticking with the theme of higher for longer, that's where interest rates look to remain. That's obviously, as we've been discussing, having an impact on the US dollar, on treasury yields, on oil. What about the local markets? What does this mean for the local markets? Because Hong Kong, the Hang Seng Index, is the worst performing out of the major markets this month. The Shanghai Composite is flat. It's down actually just a small amount, but hasn't been a good month, has it, for local markets?
Well, yes, unfortunately, this is again taking candy from a baby. The reason why Hang Seng can't perform well is whilst American interest rates remain historically high. How could it be? Our rates are connected to American rates, to US rates. So whatever else is happening, and of course it doesn't help if the property sector in China continues to be doing poorly. It is significant that the major suing activities concerning Evergrande is taking place in Hong Kong, because that's an overseas place where all this is happening. And of course, this is part of the index. Let's not forget that. We can't wriggle out of that. So that's going to be poor performance, because China is not doing well, and poor performance because interest rates remain high. It is obvious. And again, I find it very little value added. I can turn to that. Never mind that we're opening night markets in one side. This is all and part of the effort, but that's not going to drive. I don't think the poor government thinks that by doing that is going to drive the Hang Seng up. Okay, it is simply a matter of giving you a feel-good factor.
Oh, okay. William, what's your outlook for the mainland markets and Hong Kong markets?
Yeah, I think in terms of the Hong Kong market, going forward, we expect the correlation to China A shares will be higher, given a lot of global investor has sold exposure, in Hong Kong already. And second point, I think we should look ahead, not behind. We believe, the bottom is there already, although when it would coming back is a function of different, kind of like indicators, both fundamental and technical. But I think the current poor sentiment is more than, fundamental. Having said that, I'd like to update a bit on the recent observation in my trips. I visited 5 provinces in China in the last 2 weeks. Now I'm in Hangzhou, seeing the business owner. We are seeing some so-called green shoots, in the manufacturing side. It has to be sector and company specific, but I think those are indicators. For example, electric vehicle, charging manufacturer, one of the largest bike exporter to Europe, and also an energy storage, tech company. The owner is telling me that today their earnings is up 30 to 50%. So I think those are kind of like small green shoots you're seeing. I think that is reflected in yesterday, manufacturing profit jumping as well. And second point is some sell side and reporting that some of the equipment maker, like forklift, which is the equipment that you use to, for the logistic company, right? They are seeing, order increase in August as well, which means, some of the company are spending capex. I think as an investment manager, we are always talking about risk and reward. If this type of business owner starting to buying and see fundamental, improvement, potentially that would body out for a market rebound down the road. But at the same time, we believe convertible bond, this type of strategy is better that you get paid to wait. We're not suggesting that you go all in the market right now.
We did have some... Sorry, Andrew.
Okay.
Andrew, no, carry on.
Yeah, that's sweet music to my ear, William, because I do very simple things. For example, I simply opened up my Bloomberg and I looked at the first 12 indexes in China. I didn't even bother to randomize them. Okay, 12. 7 of them still contains minuses. Some of them very large minuses. Okay, over the first 3 months of the year. The first 3 months now. Correction, the last 3 months. So in other words, crudely, if somebody says, how is China doing? I said, I look at 12 basic indexes. Okay, what? Imports, exports, investment, PI indexes, the usual suspect. And of those, 7 out of 12, the last 3 numbers I have contains minuses. So in other words, more than half of my indexes are still pointing downwards. Now, some of the minuses are smaller. Okay, but I'm afraid this doesn't help me. If, let's say, my salary is coming down and it's coming down at smaller levels, that doesn't comfort me at all. I want my salary to be going up. It's not good news that the negatives are smaller. I want to see them positive. And hence, you come in and telling me that you're looking at green shoots in terms of individual places. That's much better. That's a much possibly an easier thing to say than somebody awkward like me telling you, William, really China is doing better. I've just done my basic choice and more than half of the indexes are pointing downwards. And you're telling me China is doing better. And you're saying, yes, on a sectoral basis, this is quite important. Can you please forget for the time being the macro? Okay, the macro doesn't look good.
Yeah, I think that is why we have a job, right, Andrew? If we are all, using quant and looking at the macro, we're behind the scene, and people will kind of like hit their head. Oh, gee, why I didn't, put on some exposure, when the sentiment is back. And one example, we are hosting one of the largest family office in Europe to visit China last week, and we bring them to see some domestic big family office as well. I asked the European family office, they're managing 10 billion plus. Their current exposure is 5%. And in China, they come to look for opportunity in China to increase to 10%. I said, why? You are the contrarian. They said exactly the message that I'm trying to send over. So I think we all agree that the macro is bad, the data is not good, but at the same time, there are different cycles. And I think it's seeing green shoots, at least is the bottoming out kind of signs.
And it's a pity I can't invest in Chinese defense sector. I would have loved that, but it is not possible, okay, because that's their spending. It is one of the biggest spender on defense in Asia, okay? But following closely by, actually, marching hand by hand with India. India is a huge spender on defense, and so is Australia.
Well,
Yeah.
What did you make of the industrial profits numbers that came out? The headline number was industrial profits at Chinese firms fell 11.7% in the first 8 months of the year from the same period last year. But the good news, the market seems to have taken this as good news because the decline is slowing. It was 15.5% in the previous period, but also month on month, August's industrial profits jumped by over 17%. That's the first increase this year, and that helped narrow the year-to-date decline. What do you make of that?
Yeah, two things actually. I'm afraid part of it is ignorance. I would like to know the weighting of the individual subsectors within industrial profits. Okay. And the second point is I'd love to know what caused the month-on-month big jump. Was it something very specific? Was it an individual set of companies that did that? Because otherwise, if I was to take a deep breath, and as you say, I look over either the 12 or the 18th month period with continuous declines, I will say, yeah, that's good news. But it's always the equivalent of saying, I'm helping my clients to make smaller losses. Sorry, that's not what I'm paid. Okay. In other words, I'm paid for them to make bigger positive losses. Big positive gains. And here what we're saying is good news. Okay. Things continue to be negative, but they are negative at a smaller rate. Yeah, okay. Let's see how that goes. In other words, that doesn't make me look forward to those things. So that's my answer to you. Part of it is ignorance. Okay. Since I'm not aware of the individual sectoral weights on industrial profits. And the other part is I'd like to know what was the month-on-month increase. That, as you say, make the whole other overall trend look a little bit better.
William, what do you make of it? Do you see the glass as being half full or half empty there?
Well, I think we shouldn't look too much on a month-on-month basis. The jump is big, and as you can see, from the news and analysis, there are, electricity, and some of the other components that make it improving. To me, I think the more important part is actually the corporate earnings and as well as what the business owner are doing. I think early signs, again, it would be the CapEx, capital expenditure, kind of like spending, and also the retail people. And Andrew and Peter, I would like to invite you to Changsha, which is we're opening up an office like 2 weeks ago. And interesting enough, when the Hong Kong government trying to encourage people to spend in the evening, and Peter, you would notice after 9 o'clock, not many people eat outside, right? Mm-hmm. In Changsha, which is one of the most dynamic and young city in China, my colleagues went to get a food in 2 a.m. And in a barbecue place, they need to wait for 30 minutes. I said, Jesus Christ, so many countries and places want an economy that you need to wait 30 minutes for a barbecue at 2 a.m. And you can go and Google it, look at the video. It's not a small number. All I'm trying to say is we shouldn't generalize the whole country or the whole market. There are pockets of opportunity. As a fund manager, I think our job is to make money, as Andrew mentioned, not trying to kind of like thinking about the overall big picture, but losing the opportunity.
William, I will be delighted to accept your invitation, but I want one guarantee. Are there crabs nicely? Yeah, okay. Otherwise I'm not coming.
Yeah, no crabs. That's okay. Yeah.
William, one final thing I wanted to ask you about. We're hearing sort of rumours that Beijing may relax the rules on sales by property developers, because as you know, there's all these restrictions on prices that property developers can sell new homes at. There's talk about those restrictions being eased or being lifted, which will presumably help us discover what is the true price, true value of these homes. But what are you hearing about that?
Yeah, on the ground, when we talk to the developers and other fund manager, we believe it's possible. The direction is actually to keep stabilizing or relaxing the overall housing rule, if you like. But I think the housing sector policy alone is not enough to promote kind of like the confidence for the investors as well as business owner. That's why exactly we are seeing different directions of little policy here and there. We're not expecting a bazooka type of stimulus. I think this is a good thing. If everyone is expecting this, it would be a one-off trade, if you like. If we have many different policy, while it's slowly, I believe, the confidence and the market is coming back, slowly. It's not surprise to me to see the year-to-date return gap between US and China and Hong Kong narrow down, towards the end of the year. Because we are now talking about 10, 15% type of like gap, which is not a huge, compared historically. Sometimes it could be as large as 20 to 25%.
Okay, thank you very much, William. Final thoughts from you, Andrew. Obviously, the property sector is still very much in focus, isn't it? And we've got now this Evergrande court hearing in Hong Kong where a petition's being made to wind up the company.
Yeah. Well, I have been concentrating on my favorite nitpicking, and that is, I have complete distrust whenever you are having size of debt divided by earnings or divided by profits. Okay, because size of debt doesn't have a time component. Okay, whereas earnings are earnings per period, and I'm in despair to try to find consistent numbers of the cost of servicing debt in China divided by incomes, divided by earnings or divided by profits, because that is the only one that matters. Clearly, this is irrelevant when you come to Evergrande, because whatever that ratio might be, clearly they don't have money to fund their debt. So whether the ratio is high or low is really completely irrelevant. But it makes a lot of difference when one looks at the overall sector, and even worse, when one looks at the capacity of China to increase its fiscal deficit when it comes to look something which is completely irrelevant, and that is fiscal deficit divided by GDP, which tells you absolutely nothing, okay, as opposed to finding out what is the cost of servicing China's national debt divided by income. That's the correct one to do it. And the more and more I dig into that, the more and more it doesn't look at all as grim as it makes it out to be, which doesn't make any difference when it comes to individual companies. But I'm a little bit worried of saying it looks absolutely horrible. Okay, the debts between that and income and GDP are too high. Okay, and therefore all is going to go to hell. And I keep nodding my head and I say, not when you come to look at servicing. It looks bad, but it doesn't look at all as bad as that. Because these ratios, particularly when you look at Japan, which is still fiscal deficit to GDP is 200%, so is Greece. Okay, exactly. Perfectly all right, because that's not the ratio that matters. The ratio is just how much I need every month to spend out of my income to fund my deficit. Okay, and repay, amortize, and pay interest. And that is not at all the same thing as dividing that by my overall income into the total size of deficit. Apples with bananas. As an ex-professor of 101 economics, I failed the IMF, I failed the World Bank of carry on using this completely meaningless, ratio. But anyway, who am I to say that?
What we do know is the cost of servicing this debt is going up for companies and countries all over the world, whatever that ratio may be. Thank you both very much for your thoughts, and enjoy the Golden Week holiday and the long weekend here in Hong Kong. Talk to you again very soon. You heard there Andrew Freris, who is the CEO of Ecognosis Advisory, and William Marr, who is Chief Investment Officer for Grow Investment Group. I'm joined now by Geoff Howie, who is market strategist at the Singapore Exchange. Very good morning to you, Geoff.
Good morning, Peter.
Well, we've been talking this morning about the Fed's message, higher for longer. That's what's going to happen to interest rates. Markets haven't really bought into that until maybe now, this month. They're starting to get the message, though. Do you get the feeling that investors are starting to believe that the Fed means it?
Yeah, absolutely. The Fed will always say it. We know that, but the impact that it has on the rate expectations is always the trick, and this has happened. So it's not so much what's happening in the US stock market that's impacting Asia. It's the fact that those 10-year yields are near 4.6% this morning. Dollar index is now closer to 107 than it is 106, and that has a impact of compounding the expectations of the higher rates on the equity markets out here. The thing is, what has happened is expectations for the next two Fed meetings, it hasn't really changed that much. It's still around 50-50 or 60-40 that we don't have any change before 2024, but it's that high for longer that has seen, I think, as of this morning, expectations now that we might only have 50 basis points in cuts next year versus a month ago when markets were pricing in that we'd see rates in the US come off by 100 basis points. And I remember this time last year, Peter, when we were talking, we were actually expecting rate cuts at one of these upcoming Fed meetings on 1st November or 13th DEC. So, things have changed a lot. And the problem is, this really, if you have those longer term tighter financial conditions by the world's biggest economy, that obviously can constrict global growth. And I think that's what the majority of Asia's stock markets have really snapped back into their prices this week.
And I still think maybe the market isn't exactly on board with the Fed yet, is it? Because if you look at the futures markets, Fed fund futures markets, they're saying next year 3 or 4 more rate cuts. The Fed itself, you look at their dot plot, says 2. So they're still not completely in line, are they? There could be more to come in terms of these huge moves we're seeing in bond markets, in the US dollar.
Yeah, and we haven't really seen huge moves in the equity markets out here, and there might be reasons for it, but I guess the Singapore stock market is basically part of the global economy and very much interwoven in terms of financial services, digital services, trade, and so forth. And we are well off our. When you look at the STI, well off our 3370 highs for the quarter. I think we're near around 3,200 now. We are up a little bit, 1.5% from the lows for the quarter, but still well off the highs. And that's pretty much the story for FTSE ASEAN as well, the all-share index out down here. We're trading pretty much at quarterly lows, but still down only around 1.2% on the quarter because it is mixed. In the whole of Southeast Asia stock market out here, it's not in sync. Jakarta Composite, it began the quarter around 6,700 and then is now trading around 7,000. So it's doing well, but it is obviously maintaining growth momentum. It has manufacturing remaining steady, unlike a lot of the more trade-dependent economies out here. And its FDI with the green minerals and so forth is still undeterred. And also Bursa Malaysia, I guess, is closer to quarterly highs than lows. And with this week, we actually launched a secondary listing of a palm cultivator and processor, TSH Corp, here in Singapore. That stock's up around 5-10% the quarter. So it's really, for us, it's a little bit of a tightrope in terms of whether how sensitive the stocks are to the outlook for global growth on these tighter financial conditions versus those longer-term structural drivers of growth out here in Southeast Asia, which really are threefold at the moment: sustainable infrastructure or pivots towards more sustainable renewable energy solutions or fuel-efficient transportation, the impact of food value chains. A lot of stocks that are involved in F&B value chains, either upstream or downstream, have been more robust performing than the overall broader market. And then, of course, you've got stocks that are also ramping digitalisation to grow their consumer base. So that's kind of three themes that are really working across the region that are providing at least some little offset to this week-to-week sensitivity that we're seeing on the outlook for global growth.
In Indonesia seems to tick a lot of the boxes, doesn't it? That it's a market that maybe can withstand higher rates. It's promoting those sectors that you mentioned there, and it's had a good IPO pipeline so far this year as well. Is that a market that maybe you would look to in the final quarter to outperform in this era of higher for longer interest rates?
Yeah, I mean, not necessarily, because US, as we know, it contributes around 30% of global consumer expenditure and ultimately has a massive cornerstone weight in the global stock market. I think 60% of the world's stocks come from market capitalization in the US. And for that reason, because the US is 60% of the world's stock market, it really controls the tide for the stocks. And thus you do have, you can only outpace or be defensive to a finite degree, if you will. So we really will take our cues. And Asia Pacific, Southeast Asia will still obviously be hanging on and seeing how the August PCE core deflator comes out Friday evening. But ultimately, you've got you got more things to look at here, I guess, and having that lower beta or that longer term structural growth drivers it is what we need. We've always needed the stock market to be in tandem with what's happening in terms of developing economics in this region. And, of course, we have this integration plan across Southeast Asia with the ASEAN supply chains and so forth. And when you've got a lot of FDI knocking at the door, that's always a great incentive to keep reducing barriers in terms of customs, transportation costs, so it can really fortify our place in the world.
What do you make of that news yesterday from Indonesia that the government's going to ban social media platforms from, in effect, sort of selling their goods and their merchandise on a social media platform, which obviously affects TikTok? That's the main. That seems to be the main loser from this. Is this a significant move, or is it really something that's just specifically local to Indonesia and TikTok?
Yeah, well, no, my understanding is it's a little like what we've seen in China as well, in terms of e-commerce has such an important pivotal role to play, particularly in Indonesia, with facilitating consumer-driven growth. And you have to ensure that it's appropriately regulated. Scamming and so forth is a problem when you've got this as an important element or facilitator of growth, and you've got to make sure households don't lose all their savings and so forth. And I think it comes from a regulatory angle, in that you really need to ensure consumer rights are protected, and that platforms that are being used with Indonesians having closer to 2 mobile phones than 1 mobile phone, that they're not actually going to get scammed and lose their money and so forth. And we've got stocks here in Singapore, for instance. Another example is a stock that's producing traditional Chinese medicine based in Tianjin. It's been on the right side of the reform crackdowns in terms of getting the non-licensed, the non-regulated products off the shelf. And I think we're going to see a lot more and more of that particular wide field of that tech and digitalisation has in terms of the regional economies. You've got to also control it.
Okay. What's in this era of higher for longer? Are there any particular strategies that maybe investors, particularly retail investors, could look at adopting? As an example, we were talking earlier on the show about convertible bonds. They're a good sort of hedge in some ways against interest rates being high and moving higher, aren't they? But still give you an exposure to the equity market. Are there any particular strategies that maybe investors should be looking at?
So those type of structured certificates, Peter, that have those type of bonds attached with some derivative strategy, they have been particularly prevalent here with the private banks. And also when you look at the retail investors, it's more about TWAPing, basically dollar cost averaging, trying to mitigate the risk of maybe going all in lump sum before you do have a little bit of a tumble in the market. So what they do is rather than going lump sum now, decide to evenly distribute a certain amount of money, buying units or shares in the same stock over a 12-month period, and therefore take out some of the timing risks. So yeah, structured certs are definitely very popular here, as well as that dollar cost averaging approach.
Mm. And of course, the other consequence of rates being high and bond yields moving up is the US dollar is surging as well. Now, traditionally, that's not good for emerging markets. What sort of impact is it having down there?
Yeah, that's the concern. That's the main drag at the moment, because for the stock market, Peter, it really follows trade, and China is ASEAN's biggest trading partner, and therefore we're more sensitive to what's happening in the China equity markets than we are the US equity markets. But the one key asset in the US that really does impact Southeast Asia, because the US is Southeast Asia's biggest investor, is clearly the US dollar. So it does have a drag impact, 100%. You're right.
Okay, Geoff. Well, thank you very much for that. Good to hear your thoughts there. That's Geoff Howie, who is the market strategist at the Singapore Exchange.
You're listening to Peter Lewis's Money Talk. Money Talk.
Thank you for listening to Money Talk this morning. Do please take a look at my newsletter at peterlewismoneytalk.substack.com for more information on developments during the Asian trading day. I'll be back tomorrow with the final Money Talk of the week and the quarter before a long weekend here in Hong Kong. I'll be joined by Francis Lun, the CEO of Geo Securities, and Carlos Casanova, Senior Asia Economist at UBP. And with a view from Australia is Toby Lawson, the CEO at Staten Partners. Have a good day.
Money Talk